The U.S. tax system can be really confusing. One common question that comes up is how tax brackets work. A tax bracket is a range of incomes taxed at a specific rate. And a tax bracket is a simpler way to say marginal tax rate. This marginal tax rate is the tax paid on an additional dollar of income. This means that there's different tax rates for the amount of money that you make. For instance, as a single filer, if you make up to $8,700, your federal marginal tax rate is 10%. And if you earn between $8,701 and $35,350 annually, the marginal rate is 15%. If you're making roughly $35,000 to $85,000, it's 25%. And if you're earning more than $85K, you're in the 28 to 35% federal tax bracket. However, this doesn't mean that you're actually paying these specific percentages in taxes. Each percentage rate only applies to the dollars earned within that tax bracket. Time for an example with these blocks. Each chunk represents 5 cents in taxes per dollar. Let's say that I'm a single person who earned $40,000 in taxable income. I'd pay 10 cents for each dollar, 1 to 8,700, then 15 cents for each dollar in the next tax bracket, and finally 25 cents for each dollar between $35,351 and $40,000. This means that in sum, I pay the federal government $6,030 in taxes. That's 15.1% of my gross income. This 15.1% is the effective rate, or the percentage of my income I actually pay the federal government. This differs from my marginal rate, which indicates how much my last dollar was taxed. For me, this was 25% since I earned $40,000. My effective rate of 15.1% was lower than my marginal rate because most of my income was taxed at 15%. Now, just like the NCAA tournament, taxes can be infuriating and the brackets change every year. Be sure to check the IRS for updates and come back here for more videos that help explain what's going on.